Well, good day, traders. Look, there's a tough markets to trade. There's no doubt about that at the moment. We are up against headlines. These are headline-driven markets. Whether it's a tweet from Donald Trump, Larry Kudlow, whether it's coming from the Global Times, whether it's a video that goes viral from CCTV, very much increasing the nationalistic message that we're seeing there. You know, call to action, troops on the ground, for example. The markets are driven by headlines. That makes it very difficult for us retail traders to contend with, because effectively you're up against news recognizing algorithms. Now, we've had a bit of a trend down in risk assets. I mean, you've seen the yen strengthen, dollar yen still trading below the recent swing around 109.71. We're watching to see what happens there, but the yen's been your strong proxy in the FX markets of shying away from risk. We continue to watch what's happening in dollar CNH. Yeah, we've seen a little bit of buying coming back into the offshore renminbi, but that's likely as a result very much of what they've been doing with the funding markets. You've seen 1 month and 3 month HIBOR rates moving up quite sharply over the last couple of days. It's made shorting the offshore renminbi somewhat more expensive, and that's something we'll continue to watch. It's pretty clear to me that the Chinese do not want to use the yuan as a weapon at this stage within this negotiation process, and that keeps us somewhat positive on this whole situation. Yeah, people have been buying dollars against the CNH, the offshore renminbi, but that's, we're not seeing those sort of trends at the moment that people think that we're going to see a rampant devaluation, and I don't sit in that camp that's going to happen. You go over the last 3 days, for example, for maybe even 4 days, the PBOC have had an opportunity to really strengthen the midpoint of dollar CNA or dollar CNY, and they haven't, and they've refrained to do so. So I don't sit in the camp they're going to do that, but we are seeing tit for tat. It's interesting that after a 5% pullback in the S&P, Donald Trump has gone to town. Overnight, we did see a whole barrage of different tweets, very much aimed at trying to stabilise the stock market, whether that dialogue was ongoing, that he was feeling confident that talks were going the way that he wanted to and America would win. We saw a situation where he was trying very hard to stabilise the stock market. So the question you've got to ask yourself is a 0.8% move in the S&P something that he'd be pleased with after the amount of rhetoric that he's coming through? I don't think he'd be particularly pleased. I think investors are not buying this situation. If you look at the articles that have come out overnight, the one that we want to point out is one from Axios, where they quote a senior member of the US administration team who said that the deal is not even close, and I think that's something that investors share as well. The rhetoric on the ground in China is certainly deteriorating. It's becoming much more nationalistic, as I say, and that means that's something that we find very difficult to model going forward, and that's something that will continue to see us on edge. I think it's the VIX, the US Volatility Index, the S&P Volatility Index, would actually be nicely above 20%, perhaps even above 25%, if it wasn't for the fact that central banks around the world have swung to a much more flexible, a much more accommodative setting. You can see that in the Fed Funds Future. The Fed Funds Future are pricing 24 basis points of cuts for this year, and the markets are saying that on balance, if we do see a big drawdown in financial markets that causes a tightening of financial conditions, yeah, there'll be a response, not just from the Federal Reserve, but there's going to be a response from the PBOC, there'll be a response from the ECB, probably the RBA, and also most of the G10 central banks. And I think the fact is that the big price-making central banks around the world, the PBOC, certainly the Federal Reserve, and the ECB have really gone to town of late to detail all the policy weapons that they have at their disposal should they need it. The market is feeling fairly comfortable with that. The market knows that the central banks have their back, and therefore if we do see a deterioration in financial conditions which threatens their inflation outlooks, yeah, they will see a response from the policy side from these various central banks. I think it's interesting that Donald Trump, despite saying that ultimately that he thinks that there'll be a deal and that talks are ongoing, he's still using the PBOC as an example of how those guys have stimulated through monetary policy initiatives and made aim fairly squarely at the Federal Reserve. And he's saying that he's continued to push for 100 basis points of cut. He's continuing to push for a little bit of QE, which would boost nominal GDP up to 5%. And certainly that's something that the markets are focused on, whether you're looking at modern monetary theory and looking at Donald Trump as that subversive MMT president, effectively. That's kind of what you want to see. You want to see rates being brought down to zero, the central bank coming out and buying all the bonds out there to try and bring down nominal bond yields and effectively then come out with a big fiscal plan to push against inflation. I think people are looking at Donald Trump in that regard, but that's something that's very much an interesting situation. Where do I stand on what's going on there? Yeah, well, we're up against headlines, as I say, but I do think there's still more juice in this. There's a lot of answers we need questions, a lot that we have questions for. We're not really going to get them until we see face-to-face dialogue, not until the G20 meeting comes out in the back end of June. That's a lot of water to flow under a murky bridge. My personal view is that, unless we can see a sustained move above 28.50, 60 in the S&P, then I think people will be looking at that strength as an opportunity to sell into. If we get a close below 2,800 in the S&P, my personal view is that you jump on that, there'll be an opportunity for that to move through the 200-day moving average around 27.75, and we could then start talking about a 10% move down in the S&P. And of course, Trump will continue to come out with various rhetoric to try and support that move. But I think we continue to be favourable on the yen. We continue to be fairly favourable on the Swiss franc, and we'd be looking to buy the VIX on pullbacks as well. But certainly in this environment, there's still a lot of answers that need solving. And Donald Trump can come out with tweets and try and support risk assets, but it's not going to get us that far at the moment.